Speaking of investment, we should always take the big picture into consideration. Meanwhile, observe everything in detail. Coming close to the peak of the rate hike cycle, the risk of a global recession may continue to rise. Inflation pressures are fading slower than expected, and global central banks would possibly be continuing with a greater extent of policy tightening. Financial conditions may continue to tighten. Even though equity valuations are relatively reasonable, as macroeconomic conditions deteriorate, downgrades in corporate earnings and further corrections in stock prices may be triggered. Investors may need to be more cautious with equity allocation, and we are slightly bearish overall. Even if there are brief rebounds, the bear market may stay for some time. U.S. core inflation has accelerated again. Before the midterm elections, it is doubtful whether the Fed can slow down the pace of interest rate hikes. U.S. financial conditions have tightened to a large extent because of the rise in rates and the strength of the U.S. dollar, which is not a positive factor for the stock market. Even though the current economy is relatively resilient compared to other developed markets, with high interest rates, the risk of an economic recession may increase significantly in the first half of 2023. Our view is neutral. The Russia-Ukraine situation remains uncertain. Natural gas prices in Europe continue to rise, and European states are struggling to contain an energy crisis. As the winter begins, the issue may intensify. Inflation in the Eurozone is perhaps yet to peak. Even though the economy is relatively weak, the European Central Bank may need to raise rates to a large extent. We are slightly bearish despite relatively attractive valuations. Backed by relatively mild inflation, the Bank of Japan has been boosting the economy through aggressive monetary easing, supporting the equity market. However, due to the relative weakness in yen, the central bank may intervene. Once local interest rates rise, it may dampen the economic recovery. We have downgraded Japan to neutral. Outside of Japan, the Asian economy is relatively positive, and some Asian countries may continue to benefit from the reopening after the pandemic. Overall, despite the strong dollar, the decline of Asian currency is relatively contained, and the risk of capital outflow may be controllable. However, in the face of China and the global economic slowdown, external demand may be affected. Our view towards Asia is neutral. The Chinese economy has weakened again as the stimulus from the reopening of the economy has faded, and there has been a resurgence in new COVID cases. Without a deepening of the industry regulations, together with more supportive measures to stabilize growth, investor sentiment may gradually improve. In the fourth quarter, the market is watching the outcome of the 20th National Congress and whether the zero-COVID approach can be relaxed. We are neutral on China and Hong Kong equities. We remain neutral on fixed income overall. As downward pressure on the economy has intensified, market may become more risk-averse and sovereign bond yields may retreat from a high level. We have raised our view on sovereign bonds to slightly bullish. Benefiting from a relatively reasonable valuation, the total return of investment-grade bonds may benefit from a correction in interest rates. Our view is neutral. You should always observe in detail when you invest and think of the long run. Remember that MPF is a long-term retirement investment. You should review your investment portfolio from time to time based on factors including age, stage of life, and risk tolerance level. By the time you retire, you will be able to enjoy your retirement life.